I'm here to kick off right before Pitch Club, to talk a little bit about how to raise money. In 20 minutes, I'm going to tell you everything you need to know about raising capital, whether it's a seed round or a growth round or something in between. That was a joke. There's no way I can cover all of this in 20 minutes. I'm cramming it down. It's really high level, but hopefully it gives you some of the general guidelines of raising capital, how we've been able to be successful in doing that, and hopefully it spurs some conversation. I'm happy to continue the dialogue a little bit later. Before I get started, what gives me the right to be up here to talk about capital raise? Why have I claim to be successful at it? Well, Simon mentioned 4.5 years ago, there was 3 of us, me and my co-founders, and in the past 4.5 years, we've been able to raise $65 million, gone from 3 of us to 5 offices and over 200 employees around the globe. We created an industry that didn't exist before. There was no service like ours, and we've raised money from some of the most prominent investors in Silicon Valley and New York. Silicon Valley Bank, Bessemer Ventures, Foundry, FFVC, Techstars. So we've done well, but it was a learning process. This was my first time doing it. It felt like I paved the road with my face. And so hopefully I can give a little bit back to the community, teach you what I've learned, and make your path a little bit easier if you're looking to raise money. Quick 30-second shameless plug to tell you who we are. I'm the co-founder and CEO of Distill Networks. Distill Networks helps companies identify the difference between bots and real people across your website. We have some of the world's largest property portals, including Zillow, Realtor, and we cater to even the smallest property portals like BuyRent Kenya. A third of you guys in this room might be probably our customers already, but if you aren't, we can help you protect your data from web scrapers. We can help you secure your site, make it more secure, and protect your infrastructure, and we can help you better track your customers. So if you haven't talked to Charlie outside, come and do so. All right, back to the business. To be able to raise money, you got to speak the lingo. To talk to investors, you have to use the words that they have. I'm not going to go through the list of different terms, but take pictures. I have a couple of slides of index of terms. As I go through, you can reference them to understand what the heck I'm saying. You got to know how to talk to investors. So slide 1, slide 2, take some quick pictures. All right, we're moving on. So in terms of raising money, there's really 3 categories of stages of a company. And to effectively raise money, you have to know which stage you're in, because the type of investor that you're going to cater to is different stage to stage. The first is when you're pitching a vision, right? This is before you really have customers. You're just getting started, and in that stage, you're really attracting angels that are going to give you hundreds of thousands of dollars, all the way up to seed money, which could be up to a couple $1 million. Seed money's gotten to be pretty big. Seed rounds have gotten to be pretty big now, especially in Silicon Valley. But that's the range that you're playing in. That's before you really have a lot of customers. There are exceptions to all of this, but this is kind of the general guidelines. Then the next stage of a company building is product market fit. And this is where you have early customers. This is where you have some semblance of idea that, hey, you know what, this is working. And that's when you raise your Series A or your Series B. It can be as little as $1 million to continue to prove that product market fit, all the way up to maybe a $20 million Series B. Depends on your business. And then there's the growth category. And that's really just about customer acquisition. That's putting money in and lighting it on fire and getting more customers out of it. Now, don't think of these as silos. This is actually a continuous spectrum. You're going to find some investors that say they're Series A investors, but really they get in early. They go pre-customer. You're going to find some investors that say, hey, we like early, but then they start talking to you about growth numbers and customer acquisition costs and all these things. So just think of this as a continual spectrum. And you're going to find people that generally in a scatter plot fall in one of these categories. You need to know where you fall in to be able to effectively pitch them. So, early on, I said it was a painful process for me to raise money. If you've gone out there and failed at raising money, you know it's not just about having a huge market opportunity and a good product. You got to find the right investor that's interested in what you're doing. It's really like threading a fucking needle. It's a pain in the ass to find that perfect fit. And so don't be discouraged to say, oh, you know what, like they don't get it. I don't understand what's going on. If you draw the Venn diagram, the world of which you're going to get money is that little tiny sliver. And that's if you have a huge market opportunity and if you have an amazing product. You got to get those two, and then you might have that small sliver of opportunity. So it's painful. Let's talk about the different rounds. The first division, the seed round, getting started early, right? What does that mean? Well, first of all, it means to get the vision, to really narrow it down. It's not just an idea in your head. Right? You gotta flush it out a little bit more. So step one is really talk to potential customers, get an idea of how this plays out. Don't just solve something because you think that you can do it better. Validate it. And it's so easy now to validate. You can go to Startup Weekend, you can do hackathons, you can set up a landing page or do a mock-up. You can for very little cost get some idea of how what your vision is resonates with customers. And that's really key here, because you want to validate your assumptions. You want to take your vision and make sure that it connects with some people at some level. And then you want to get some commitments from people. Get some semblance of, hey, you know what? Like, if I build this, would you be interested in it? I didn't leave my job. I was building my company on the side at my last company, and I didn't leave my job until customers said, you know what? If you build this, we'll buy it. Then I quit. I put in my notice, spent 9 months building it, and you know what? They came in. They were our early customers, and that made a lot of sense. And then build a team. I'll come back to that, but building the team is really critical. That's the first part of developing your idea. Now, what's interesting is nowadays, more than ever, it's cheaper to get things off the ground. 15 years ago, it took $1 million to get a business started. You have to have servers, coding was expensive, it was hard. Right now, you have AWS, you have frameworks. It's simple to get things off the ground. And unless you've done this before, unless you're a successful entrepreneur, having an idea and a pitch deck, that's not going to get you money. They want a minimal viable product. Investors want to see that you've built something that resonates, that makes sense, that you've taken a first step. And people get this wrong all the time. People try to over-perfect the minimal viable product. They try to build the car right away. And what they do is they build a tire and they show, hey, look, here's a tire, here's the frame. All I have to do is put an engine in it, and we're off to the races. But you know what? A frame of a car doesn't give any value. A minimal viable product is something that your customer, the potential customer, can use to a little bit, just get a little bit better than what they have today. So in this example, this outlines it perfectly, right? Instead of walking, I can ride a skateboard. It's not a car. It's not going to get me from here to Cambodia. But you know what? It'll get me down the street a little bit faster than walking, and that's a minimal viable product, right? And I can keep improving that until I get to a bike, a motorcycle, and then I get a car. And that's the key there, is getting a minimal viable product is important for this vision stage. And the last piece is pitching your idea. You gotta have a strong team, and this is the most important part, right? You don't have any customers. You don't have anything built out yet. So what are they really investing in you? They're investing in your team. When we were pitching it, that's the thing that our investors love the most. Not only did we have subject matter expertise, in which I came from denial of service mitigation, my co-founders were network engineers, but they also know that the team was going to be working well together. We knew each other since 7th grade. We were best friends, and they knew that no matter like hell or high water, we were going to make it work and we were going to stand by each other's side. Team is important. That's the most critical part that early stage investors invest in. Then they want to know the tech or the product. They want to know what's different about you, what's unique, how hard is it going to be to replicate. If you start getting some traction, is somebody else going to do it really quickly? Then how big is this market? Is this a big opportunity or is this a meh? That's important, right? And then getting that initial customer validation, getting those commitments, getting the signups on the landing page, something to show that people are willing to do this. Right? It's all about risk reward at this very early stage. These early investors want 10x their return. They want 10x return on the investment that they give you, and they want to know that the risk is less than 50%, right? Is the team going to fall apart? Is the tech going to be a flop? Is the market big enough to give that 10x reward? That's what you need to understand about these early stage investors. Now, once you take early stage money, the next thing that you need to do, the next stage to raise a Series A, the next round, is finding product market fit. And this is the thing that I think people mess up the most. They take money early on and they think, you know what, I'm going to build the tech and then take more money and then acquire customers. That's not good enough. You're going to die in no man's land where you're too expensive for early stage people and Series A investors look at you and say, you know what, you haven't proven anything. And Marc Andreessen says product market fit means being a good market with a product that can satisfy the market. That's really ambiguous. That doesn't really help us, right? This is a little bit better, right? You're starting off on the very far left, very far right. I'm looking up there. And you want to get closer to a point in which your ability to acquire customers is, and the value that you extract out of your customers is greater than the cost that it takes you to acquire those customers. That's really techie. That's still kind of ambiguous. I think Sean Ellis and David Cummings say it best. Product market fit, Sean Ellis says it's essentially where if 40% of your customers would freak out if they didn't have you. That you show enough value with the early traction guys that, you know, a third or a half of them can't live without you, right? Or David's explanation of product market fit, I think, really hits the mark. First is, can you acquire customers in the same manner? Can you find the customers and can you onboard them in a repetitive manner? Are they going to use your product in the exact same way? Are they going to be actively using it without finding bugs? Are they going to be using it in a way that you don't have to customize it for each person? If you could say yes to those four things, and you can find maybe 10 customers, or if you're going to a consumer product, multiply that by 10, hundreds of customers in a 3 to 9 month span, then that shows you have product market fit. That's key there, is to understand that, you know what, it's a repeatable process to find customers, acquire them, and how they use it. You know exactly who's buying you, how they're using you. It's predictable, it's repeatable. That's what product market fit is in that next phase, that Series A investment. And it may take you a couple rounds to really nail that, but once you do, once you've really figured out those metrics, this is the golden area. This is where growth capital comes into play. And it's all about, it's a money machine. This is all they think about. These guys, the growth investors, are quite literally just going to come to you with a spreadsheet. And they're going to ask you for a bunch of different numbers, and it's all going to be distilled down to one thing. If I put $1 in, I want X dollars out. And okay, how much is X dollars out? What does that really mean? Well, let's do some reverse engineering about these growth investors. Seed investors want 10x returns. Product market fit A investors want 5 to 10x returns. Growth investors are a little less greedy. They know that there's less risk here. They want 3 to 5x returns, right? So let's say hypothetically they give you a $20 million investment at a $150 million post-valuation. That means they own 13% of your company. If they own 13% of your company and they want 3 to 5x returns, then they want, on that $20 million investment, they want a $100 million return. Right? So $100 million return, to get that, your company has to be worth $750 million on their exit for 13% of your company to return $100 million to them. Right? They own 13%. They want $100 million back out of that 20. You got to be worth $750 million on exit. Well, so now you're worth $150 million now. You got to be worth $750 million on exit. That's a $600 million gap in value that you have to make up. How do you do that? Well, valuation multiples come down. At the end of the day, in public markets, if you're a fast-growing company or a good company, you're going to get 7 to 10x returns on revenue, a multiple on revenue in terms of your valuation. So let's say 7.5 times to make it even, to make it simple. So to get $600 million of value into your company, at a 7.5x multiple, that means you have to generate $80 million of revenue with that $20 million that they gave you. That's a lot of math, but hopefully you're following along here. They give you $20 million in, and they want you to generate $80 million. For every dollar they give you, they want you to generate $4 of revenue. That sounds really hard. That's tough math to come up with. But it makes it a little easier if you can do recurring revenue, right? They don't expect you to do it in a year. They want a 3 to 5 year time span. That you take that $1 and turn it into 4. Well, if every year you can take $1 and get $1 back out, and you keep that dollar printing out, and then you can take that dollar and put that dollar into something else, and then get $2 out year 2, and then put those $2 in, and then year 3 you have $4 out, you figured it out. The math works. Recurring revenue is the key to putting $1 in and getting $1 out. That's one of the simplest ways. That's why recurring revenue SaaS companies get the highest multiples in venture and in public markets. So to do this, I told you they're going to come in with a spreadsheet. They're going to analyze your business. Here's some metrics that they're going to ask you about, and here's some of the details of who's the best. What are the best metrics to achieve? Customer acquisition cost. This is how much it costs you to acquire a customer. The best companies, the companies that get the highest valuations, the companies that have the highest multiples on the public markets, their customer acquisition cost is less than their annual contract value. Remember that $1 in, you get $1 out? How much it costs you to acquire a customer, it takes you less than 12 months of having that customer to get that back. So for every $1 you spend on marketing, sales, whatever, you'll get that $1 back in under 12 months. That's one of the golden metrics to look for that investors in growth stages look for. Next thing they talk about is churn. That recurring revenue model only works if the bucket doesn't leak. If I'm taking $1 out and then I lose that customer on year 2, then I'm not getting anywhere. So for growth investors, they want an annual churn of less than 10%. That's the best companies. An annualized churn of less than 10%. If you have an annualized churn of over 20%, you're in no man's land. In that medium grade to 10 to 20% annualized, they'll still be investable. But if you're over 20%, you're not getting a dime from growth investors. It's too leaky of a bucket. Then they also actually care about this. It's called upgrades, cross-sells, net churn. They want to know that without any investment into sales and marketing, can your business organically grow? And the best companies, they can take their existing customer base and find other ways of making money off of them. And the best companies out there, the top 50% of companies that have high multiples, upsell or cross-sell their customers by 25 to 35% every year. So you can find new ways of extracting more money, whether it's by raising prices, whether it's by introducing new services, finding more ways to extract more value out of your customers. That helps you appeal to growth investors. Then there's a bunch of different acronyms, TCV, ACV, LTV. At the end of the day, the most important one is lifetime value. When you get a customer, not just how long is it, what you get out of them year 1, but how much do you get out of them year 2, year 3, until you lose them, what is the lifetime value of this customer? And a good business is one in which your customer acquisition cost is at least half or a fraction of the total lifetime value that you get out of a customer. If it costs you more to acquire a customer than you get out of them in a lifespan, you're not getting very far. You're going to be, it's a money pit that nobody's going to invest in. And then the last rate, the most important one, I think, is growth rate. And people get this wrong all the time. They think, you know what, I'm growing 40%, that's great. Well, 40% doesn't matter at early in the pre-IPO stage. The stage in which you're $10 million of revenue to $100 million of revenue, the top SaaS companies are actually growing at over 70% year over year. That's the target. That's the golden number for annualized growth rate, for that growth period that investors really drool over, that they get excited over. Because every year, your growth rate is going to diminish by 10 to 20%. The average for companies that have gone public, leading up to going public, every year their growth rate slows down by 10 to 20%. So if you start at 70%, by the time you get to be a publicly traded company, that's how you end up at 40%, and that's the magic number for publicly traded companies, that public investors see you as a high growth company. And those are some of the key metrics. was absolutely a learning process for us, but honestly, it's a crapshoot. The models that we put together early on are so wrong, and the investors knew it. The thing is, it's not about getting their model right, but the things that go into your early model help explain to investors how you understand the business, right? If you can take your business and explain it in a spreadsheet, then it shows an investor that you've thought through the inputs and the outputs of the business. It's not about getting the model right, because our model was shit. It was just completely wrong. But it's about how we came into those assumptions that really resonated in terms of the vision stage and the product market fit. As you get closer to product market fit, the model has to be closer and closer to being accurate. In the growth stage, they pick it apart to like every bit of detail. Addressable market is my it instills like this like PTSD, because that was a question I kept getting asked and I had no idea how to answer it early on. It was just like, fuck, I don't know. Like, I thought this was your job, but it's not. You got to remember, guys, investors are mostly generalists, right? You have to educate them for them to want to invest in you. And so to do that, you have to be educated and understand the market that you're going into. And so addressable market, total addressable market is one of the key things to explain, and there's two great ways that I think I've learned to do it. One is bottoms up, in which I say, this is how much we charge these 2 or 3 customer types. We charge this one $500 a month, we charge this one $1,000 a month, and we make $20,000 a month out of these ones. And in the universe of people that care about what we do, in the universe that we have the product market fit, there's this many of each category, and then you multiply it out. You say there's 5,000 of these guys, 10,000 of these guys, and then 20,000 of these guys, times the value, the amount that we get out of each one, the revenue that we get from each one, and that turns into your total addressable market. Or the cheating way, the way that actually resonates better with investors, is going to analyst reports and either finding a similar market or finding analyst reports about your market. We put a lot of effort in the bottoms-up approach. Analysts poo-pooed it. Or investors poo-pooed it. I spent weeks, and then they crapped all over it. They trust analysts a lot more, and so taking a Gartner report is the easiest way to answer the TAM question. That's our path is heading towards IPO. We are going to be cash flow positive this year. Raising money is like a heroin train. It's really, really hard to stop chasing that dragon. And this is the first year for us that we're gonna not raise any more. I've been raising every year since we started. We don't need any more money. We're well capitalized. Now it's just about continuing the growth and hopefully getting to that IPO. That's our trajectory.